Ladies and gentlemen, the Asian guy here. Here is a question that nobody on financial television is asking tonight. If the price of silver is just a number on a screen, what exactly happens the day the vault behind that screen runs empty? What happens when the manufacturers, the engineers, and the supply chain managers who built their entire production operations around physical silver show up to collect and the shelves are bare? Because that scenario is no longer a thought experiment, what I am about to show you is not a rally. It is not a breakout. It is an inventory record, a 12-month depletion chart that is quietly announcing the most consequential shift in the precious metals market in modern history. And once you understand what those numbers actually mean, not just what they say on the surface, the price you see quoted on your screen will never look the same again. Today is Wednesday, May 20th, 2026. The COMEX vaults are speaking. The question is whether you are listening. Let me give you the numbers. As of today's close, silver is trading at $75.72 per ounce, up $2.16 on the day, a gain of 2.94%. Gold is at $4,542.10, up $61 today. To most people watching markets tonight, those are just prices. They see a percentage, they feel something about their portfolio, and they close the app and move on. But here's what they are missing. They are not looking at what is behind the price. They are not looking at the vault, because if they were, they would immediately understand that the number on their screen and the number of ounces physically available for delivery have become two very different figures, and the distance between those two figures is expanding every single day. Here is what this video is going to walk you through. I am going to show you the COMEX silver inventory chart, a year-long drain that has no precedent in the recorded history of this market. I am going to explain why 36 categories of industrial silver users represent a demand floor that no contract, no promise, and no paper settlement can satisfy. I am going to take you to the gold vault, where a structural shift that began in 2020 has now entered a new and more acute phase in 2026. I am going to show you what it means that physical demand in the first quarter of 2026 was running above its 5-year average even while the paper price was pulling back. And I am going to show you why consumer confidence collapsing to its lowest point since 1952 is not a recession indicator. It is the final warning signal, the last remaining structural support holding this entire monetary system upright. When that support gives way, today's date will be the reference point, Wednesday, May 20th, 2026. Market. Let's go to the inventory chart, because the COMEX silver inventory record over the last 12 months is one of the most readable financial documents in existence right now. You do not need a background in derivatives. You do not need to understand futures pricing curves. You need to look at a line that runs from the upper left to the lower right and understand that what it is showing is not a market fluctuation. It is a depletion schedule. Over the course of the past year, more than 312 million ounces of physical silver have been drained from COMEX vaulted holdings. 312 million ounces. That number is not the result of technical selling or portfolio rebalancing. It is physical metal leaving the system. And here is the detail that changes everything. When silver leaves the COMEX vault, it does not come back. It moves to a fabricator. It becomes a solar cell. It becomes a circuit board. It gets consumed in an industrial process that converts it permanently into a finished product. There is no mechanism by which that metal re-enters the registered inventory pool. The drain is structural. It is directional. It is irreversible. And the 36 categories of industrial users who depend on that inventory are not negotiable counterparties. They are manufacturers. They have production deadlines, assembly line commitments, and procurement contracts. They cannot accept cash settlement in place of an ounce. They need the physical bar, and that need does not diminish when the COMEX inventory chart points toward zero. It intensifies. Now let's address the mechanism that has been masking this physical reality from the price screen. When a trading desk or financial institution creates a silver futures contract, they are generating a legal promise and agreement denominated in dollars. To deliver silver or to settle in cash at some future point, the operative word is or. In practice, the overwhelming majority of these contracts are never fulfilled with physical metal. They are rolled forward into the next expiration. They are cash settled. They are extinguished on paper before a single bar changes hands. This is how the paper market has been able to set a silver price for decades without ever needing to match that price to the physical availability of the underlying metal. But the balance is shifting. Entities are now exercising their right to stand for delivery. Not rolling, not accepting cash, showing up and demanding the actual bar. Each time that happens, the registered silver, the fraction of total COMEX inventory that is contractually earmarked for delivery, shrieks. The gap between the paper price and the physical reality of what can actually be delivered grows wider, and there is no paper mechanism that closes a physical gap. A contract printed in New York does not add an ounce to a vault in New York. Eventually, the weight of physical demand outpresses the capacity of contract creation. Not because the paper players run out of creativity, because the metal they are promising has already left the building. This same pressure is now visible in the gold market, and what is happening there tells you exactly where the silver story leads. The COMEX gold inventory chart, stretching back to 1993, shows a pattern that has fundamentally broken. From the early 1990s through 2019, the inventory trend was relatively contained. Then in 2020, a massive upswing, the system scrambling to build gold reserves as the first large-scale fractures in fiat confidence became visible. And then, beginning in 2025 and accelerating into 2026, the inventory falls off a cliff, over 25 million ounces of gold drained from COMEX holdings. In a single 24-hour window, not gradually, not in tranches, gone. Where is this metal coming from when it briefly replenishes, and who is pulling it out when it drains? The replenishment is coming from European custodial reserves, from Switzerland, from Bank of England holdings lent or leased into the system to maintain the surface appearance of adequate supply, not from China. China does not release gold. China is a one-directional accumulator, so the metal that briefly appears in Western vaults is sourced from sovereign and institutional reserves that are being steadily exhausted, and once it is delivered out to whoever exercised their claim, it exits the Western financial system permanently. The pipeline that has been patching this shortage for years is running out of inventory to draw from. That is not a recovery signal. That is the last reserves being spent. Three forces are driving this drain simultaneously, and you need to understand all three to see where this is going. The first is inelastic industrial demand, 36. Categories of physical silver users cannot substitute the silver that goes into photovoltaic manufacturing, into defense electronics, into medical instrumentation. It must be physical. Refined to specification and available on a defined delivery schedule. These industries have undergone a fundamental shift in procurement behavior following recent supply disruptions. They are no longer ordering reactively. They are building forward inventory. They are acquiring metal ahead of need to ensure their production lines never face a supply interruption. This means the demand currently flowing against COMEX inventory is not simply real-time consumption. It is real-time consumption compounded by strategic pre-buying. The demand floor is not a price level. It is an operational necessity that does not respond to a lower spot quote. The second force is central bank behavior. Central bank buying of physical precious metals remained elevated through the first quarter of 2026 even as the spot price pulled back from its recent peak. Sit with that data point for a moment. Central banks are not momentum traders. They do not chase rallies. They do not react to short-term price signals. When sovereign reserve managers are buying into a period of price weakness, they are not speculating. They are building savings. They are positioning their national balance sheets for conditions under which fiat currency loses its function as a reliable store of value. A country that exhausts its hard asset reserves when its currency comes under pressure has nothing to fall back on. The central banks purchasing physical metal at elevated rates during a retail pullback are signaling with institutional clarity what they believe is coming. That signal carries more weight than any financial media headline. The third force is the structural savings gap between institutional behavior and retail conditioning. An entire generation of consumers has been systematically trained through installment credit platforms and buy now pay later culture to spend rather than save and to accumulate payment obligations rather than hard assets with no counterparty risk. The result is a population that, at the moment the system cracks, holds debt instead of metal. While sovereign wealth managers are quietly filling their vaults, ordinary people are filling their monthly payment calendars. This divergence is not accidental. It has been cultivated, and it means that when physical silver becomes genuinely scarce, the majority of people who most need financial protection will have no position to stand on. Here is the data point that deserves far more attention than it has received. In the first quarter of 2026, physical demand for silver was running above its 5-year average despite the fact that the spot price had retreated from its recent highs. In any normally functioning commodity market, a falling price reduces demand. Buyers wait for cheaper levels. Procurements lows. In the physical silver market in the first quarter of 2026, the opposite was true. The price fell and demand accelerated, because the buyers driving that demand are not price sensitive. They are availability sensitive. They are industrial procurement managers and central bank reserve officers who understand that the risk they face is not paying too much for an ounce. The risk they face is not being able to find one. This behavior has a precedent. In 2020, the iShares Silver Trust was forced to restructure because it could not source sufficient physical metal to assemble its statutory delivery baskets. That constraint did not resolve the structural shortage that surfaced publicly in 2020 has not been repaired in the 5 years since. It has grown. The demand curve in the first quarter of 2026 confirms that the physical market is now operating on a logic completely independent of the paper price. The screen quote is one market, the vault inventory is another, and they are pointing in opposite directions. Let me give you a measuring tool that cuts through the noise, because at this stage of the monetary cycle, measuring silver in dollars is like using a yardstick that is itself getting shorter every month. The instrument of measurement is degrading along with the thing it is supposed to measure. So let's use the ratio that has anchored monetary thinking for most of recorded history. Let's measure silver against gold. Gold today, $4,542.10. Silver today, $75.72. Divide those numbers and you get a ratio of approximately 60:1. That is what it costs in silver ounces to purchase a single ounce of gold right now, for most of monetary history and across most Of the major economic civilizations that use these metals as money, that ratio held at approximately 15 to 1. It reflected physical scarcity in the Earth's crust and the dual monetary role of both metals. If silver were to return to that historical monetary relationship with gold at today's gold price, the implied silver price would be approximately $302 per ounce. At $75.72, silver is not overvalued by any reasonable historical standard. It is trading at roughly a 75% discount to its historical monetary fair value relative to gold. That is not a trading opportunity. That is a structural mispricing of historic proportions that the physical drain on the COMEX is beginning to forcibly correct. Now I need to take you to the data point that is receiving the least attention and carrying the most structural weight. Consumer sentiment in the United States has just registered its lowest reading since the index was first tracked in 1952, not the lowest since the financial crisis, not the lowest of the current decade. The lowest in 74 years of recorded data. Why does this number matter for silver? Because the fiat monetary system has been kept operational by three supporting pillars. The first was institutional confidence, the belief of central banks, sovereign funds, and reserve managers in the credibility of the dollar system. That pillar fractured years ago, which is precisely why central bank gold acquisition has been running at multi-decade highs. The second pillar was market confidence, the belief of corporations, asset managers, and investors that paper financial assets reliably store value. That pillar has been fracturing visibly since 2022. What we are now watching deteriorate in real time is the third pillar, public confidence. The working assumption of ordinary people that the system is functioning, that their savings will hold purchasing power, and that the currency in their wallet will buy something meaningful next year. When that assumption collapses and the 1952 low tells you the collapse is underway, there is no fourth pillar, the structure comes down, and the assets that survive that kind of structural failure are not the ones that require an institution to guarantee their value. And the Federal Reserve has no viable path out of this. The Consumer Price Index came in hot. Again, the mandate says, raise rates to combat inflation, higher rates, slow borrowing, slow spending, reduce price pressure. That is the textbook. But here is the reality. Higher rates collapse the discounted cash flow valuations of every major financial assets simultaneously. Higher rates make the interest cost on $37 trillion of accumulated federal debt unmanageable. Higher rates shatter the housing market, the equity market, and the corporate credit market in sequence. The Fed cannot raise rates aggressively without triggering the collapse it is supposed to prevent, but it also cannot lower rates. Lowering rates while inflation is already elevated tells the market that price stability has been abandoned in favor of asset price support. It accelerates dollar debasement. It accelerates the rotation from financial promises to physical assets. Every quarter the Fed is asked to choose between two paths, and every quarter both paths lead to the same destination, elevated demand for silver. That is not an opinion, that is a mechanical outcome. When both policy options converge on the same result, the trade is not conditional, it is structural. And then there is this. Kevin Walsh has cleared his Senate confirmation hurdle for the role of Federal Reserve Governor, with a potential chairman vote arriving as early as this week. A regime change signal at the top of the world's most consequential monetary institution arriving simultaneously with hot inflation data. The lowest consumer confidence reading in 74 years and a historic COMEX inventory drain. These are not unrelated events. They are converging pressure points around the same central vulnerability, confidence in the institution that sits at the foundation of the global fiat system, when the occupant of that chair is in question. The certainty premium that dollar-denominated assets have carried for decades erodes, and when certainty erodes, physical assets with no issuer and no required institution to maintain their value absorb the capital that leaves. So let's talk about positioning, because data without a framework for action is just a longer version of anxiety. The first principle is this: a futures contract is not silver. It is a legal promise denominated in a currency that is being devalued to fund the crisis that is making silver valuable. The COMEX inventory record has demonstrated in its own data that the registered physical silver available for delivery is being drawn down at a rate without historical precedent. Holding a financial instrument that tracks the paper price is not the same thing as holding the asset at the center of this repricing, physical silver coins bars in your direct possession or in allocated and independently audited storage that you control removes the counterparty risk that is the core vulnerability of every paper product. Yes, premiums over spot price exist right now. Those premiums are not a penalty. They are the market's honest acknowledgement of what physical availability actually looks like when you remove the paper overlay. The second principle is to define your exit correctly. Your exit from silver is not back into the currency that is creating this crisis in the first place. The objective is to hold through the repricing phase and rotate into productive hard assets, land, income generating real estate, energy, infrastructure. Time to when the gold to silver ratio compresses to historically meaningful levels. The goal is not a dollar profit. The goal is a structural swap from an undervalued monetary metal during the suppression phase. into productive assets that generate real cash flow when the ratio reaches the kind of compression that marks the end of a precious metals monetary cycle. The currency is the exit risk, not the asset. The third principle is to treat volatility for what it actually is. The paper market will manufacture price moves designed to dislodge. Retail holders, when you see a sharp intraday move down on the silver chart, return to this data point. Physical demand in the first quarter of 2026 ran above its 5-year average even as the paper price fell. The screen and the vault are operating on different logic. Sharp paper moves down do not put silver back in the vault. Smart money use that divergence to accumulate. That is the behavior worth replicating. 3 metrics should be on your watch list from this point forward. The first is COMEX registered silver inventory, not total. Inventory, registered. Registered is the specific metal contractually earmarked for physical delivery. When registered inventory falls, the buffer between the paper promise and the physical reality shrinks. When it approaches critical lows, the paper market loses its operational capacity to suppress the physical price through contract creation. That number is the most structurally honest data point in this entire market. The second metric is the continuation of the Q1 demand trend. We now have confirmation that physical demand ran above its 5-year average in the first quarter of 2026 during a period of paper price weakness. If that pattern extends into the second and third quarters, it confirms the drain is structural rather than seasonal. Structural drains do not reverse. They accelerate. Knowing which type of drain you are watching determines everything about how you should be positioned. The third metric is the consumer confidence reading. We are already at the 74-year floor. The trajectory from here matters more than the level. A continued decline in that reading is the trigger condition for the third pillar of the fiat system to give way. And when the third pillar goes, the transition speed will not be measured in quarters. It will be measured in days. Here is the nature of what structural breakdown looks like in a physical commodity market under this kind of pressure. These systems do not erode at a linear pace. They hold and hold and hold, and then they fail catastrophically and all at once. The COMEX inventory chart already has a cliff on it. Registered gold vanished by 25 million ounces in a single session. Silver by 312 million ounces over the arc of the past year. The rate of those drains is not decelerating. Central bank buying elevated in the first quarter of 2026. Consumer confidence at its lowest since 1952. Inflation running hot. A potential regime change at the Federal Reserve. These are not background conditions. These are the conditions under which nonlinear moves occur. When nonlinear moves happen in a physical market with this kind of structural drain underneath it, the window to act before the move is not weeks, it is sessions. I want to speak directly to anyone sitting here right now calculating a profit at $75.72 and thinking about converting that into cash. Here is the calculation you need to do instead. At $75.72, silver is still priced at approximately 75% below its historical monetary fair value relative to gold. The COMEX vault is draining at a pace without recorded precedent. Central banks with institutional knowledge of how currency systems fail are buying at elevated rates into price weakness, and the confidence index that has been tracked since 1952 just printed its all-time low. Those are the conditions under which you sell the scarce physical asset and rotate back into the instrument at the center of the crisis. That is not taking profit. That is exchanging the asset that benefits from every possible policy outcome for the liability that created the conditions driving the crisis. The institutions you would be selling to understand this asymmetry clearly. They are building positions, not liquidating them. Let me close the loop on what central bank behavior is actually telling you. In the first quarter of 2026, central bank acquisition of precious metals remained elevated while retail sentiment was cooling and paper prices were pulling back. Sovereign reserve managers do not buy gold and silver for yield. They do not buy them for momentum. They acquire them because these are the only reserve assets. With no counterparty, no issuer, no maturity date, and no institutional guarantee required to preserve their value. When a country's currency collapses, when its debt market sees, when its fiat obligations become unserviceable, it is the hard metal in the vault that gives the sovereign the capacity to rebuild. The elevated central bank buying in Q1 2026 is not a tactical position. It is a national savings decision made under the assumption that the system will face conditions severe enough to require that kind of reserve. These are not institutions speculating on a trade. These are institutions preparing for a scenario. The 3 forces this video has documented are not 3 separate stories. They are 3 independent lines of evidence converging on the same conclusion. The COMEX inventory drain tells you the physical supply side is breaking. The central bank buying behavior tells you the institutional world has already incorporated this outcome into its reserve strategy. The consumer confidence collapse tells you the public anchor that has been holding the fiat system operational is giving way. 3 data streams, 3 independent confirmations, 1 structural outcome. The physical market is in the process of enforcing a repricing that the paper market has deferred for decades. That process is not a future event. It is already visible in the inventory data. It is already visible in the Q1 demand figures. It is already visible in the ratio between what the screen says and what the vault holds. The window to position before that repricing becomes the headline is not open indefinitely, if you are watching. This video, you already know something that most people scrolling through financial content tonight do not. You found this channel, you stayed through this analysis, you looked at an inventory chart and understood what a directional drain means for the price discovery mechanism that sits on top of it. That is not a trivial thing. Most people will see a silver price quote today, register a percentage, and keep scrolling. You are not operating that way. You built your position when the paper narrative was loudest and the metal was cheapest. Now the only task remaining is the one that separates the people who preserve wealth from the people who almost did. Do not hand that position back. The manufactured volatility is coming. The shakeout attempts are engineered. The media voices calling tops will multiply as prices rise. None of that changes what the vault inventory says. None of that changes what central banks are doing with their reserves. None of that changes what 60-1 looks like against a 15-1 historical baseline. You hold the physical reality. Let the paper players keep the promise. If this analysis was useful to you, subscribe to the Asian Guy and drop a comment below. Tell me what you're seeing on the ground. Are premiums rising where you are? Is availability changing? I want to know.